What's up, guys? So in this video, we'll be finishing part 2 of question number 1. This is basically a continuation of the previous video where we covered question number 1A and question number 1B, which is the income statement and statement of financial position. But in this video, we'll finish part C and part D. So part C, Roman 1 says, explain with reference to an accounting concept why Bilal maintains an allowance for irrecoverable debts. Concept and explanation. Roman 2 says, explain with reference to an accounting concept why Bilal always maintains the same method of depreciation for each class of non-current asset. So this question is basically requires us to understand the accounting concepts. So by knowing the accounting concepts, we'll be able to know or identify that for Roman 1, the concept will be prudence. Now, what does the prudency concept state? It states that we must avoid to overcast or undercast the assets and liabilities and also all the other transactions inside the business. So let's check in the marking scheme what they say. It's very similar. See, avoid overstating the profit of the year. This basically means that because by overstating the assets and liabilities, the profit will also be overstated. So yeah, that's Roman 1. Roman 2. Start here. Explain with reference to an accounting concept why Bilal always uses the same method of depreciation for each class of non-current assets. So the answer here will be consistency concept. This is because the consistency concept states that for each year or each financial period, we must use the same accounting method to record the transactions. This will help us to avoid any mistakes. Yes, so this is the principle of consistency, which is here, consistency concept, which basically enables us to compare the results year to year. Okay, now this is the next part D. Bilal hopes to expand his business and to move into larger premises. He is considering the following options. Option A, renting out the whole current premises and taking out a lease on new premises. Now, what are the advantages and disadvantages of this option? So when we rent out current premises, this allows us to continually be receiving rent receivable. So yeah, this is one of the advantages, and also there's no interest on returns. I'm trying to think of some other advantages. We have let's move on to option B. Selling the current business premises and using the proceeds to partly finance the purchase of new premises. He is aware that he will also need a bank loan to finance the balance of the purchase price of the new premises. Now, what does this actually mean? This basically means that Bilal basically has a business, maybe let's say worth 1 million Tanzanian shillings, and then he needs to purchase a premises which is worth 2 million. Now, by selling this current premises, which is 1 million, we'll be able to get 1 million. but it's not enough to satisfy the amount. So we have to use a bank loan to purchase the 2 million business premises. Therefore, we will acquire a bank loan. But now the disadvantages of this is that always when we're returning a bank loan, we have to return it with interest, which will be the bank's profit. So that's one disadvantage. And also, there'll be no rent received. There'll be no rent receivable. So when we receive the amount, that's it. There's no more additional receiving. Let's check here. Yeah. We have some here. Retains ownership of potentially valuable non-current asset. This basically means that because we do not totally sell the non-current asset, this means that the non-current asset is still in our ownership. So we do not 100% lose the value of the non-current asset, because we can anytime attain the non-current asset for our own personal use. Okay. Yeah, the rent received will help us finance the cost. This is true because we're continually receiving the rent received, which can help us to cover the operating expenses. Yes, less permanent arrangements. We can have flexibility because we can always be receiving rent receivable. Option B, this is also true. We will gain potentially more valuable current assets because we're selling this one and getting better current assets. But this point is also the same. We can see this point in option A because we're also selling it and getting a better asset, right? Yes. Also, we'll lose current rental income. This is a disadvantage because we're not renting it. So we just get fixed amount of money at the beginning of the financial year. We will incur costs by selling. This is true because when we're selling the premises, we will incur some costs, maybe costs of advertising the business for sale. So yeah, although it's small costs, we still incur. Interest and bank loan. Yeah, this is also true. Okay, thanks for watching part 2 of question number 1. Hopefully you understood. Stay tuned for next video. We'll be explaining question number 2 of this past paper. Thanks for watching. See you in the next one.